Hello, hello. Trying out a different format here on the 40 Finance channel. This is the live feed. I'm going to talk a little bit about things that are going on the stock market today. Let me try to figure out some of this technology here. But so today is May 14th, and here we have Yahoo Finance set up. And let's take a look at what's going on. I like to track the NASDAQ myself. So today you see we kind of started off low, dipping down to 8,700. It's sort of working its way back up. But year to date, what's amazing right now about the NASDAQ is just how much it's recovered. So you can see on February 20th, yeah, 9,800. We just yesterday we were at almost 9,200, or a couple days ago that is. We had a nice little downturn this week. I say nice because things have been way too high in my opinion. So hi Reed. So again, it's been nice as far as my opinion to see a little bit of a downturn. Now I want to go into some of the stocks that I watch, most notably start with an ETF here because I'm, again, Reed, you're the only one here, but I'm still learning this kind of system. So I'm going to try to share my whole screen. I think I'm doing. But so this is the IYC US Consumer Services ETF. This is a big one for me, and you can get an idea over here on the holdings side, what type of stocks it holds, right? So there's the top 10 holdings, 50% of total assets. You got your Amazon, Home Depot, McDonald's, Disney, Walmart, Costco. Long story short, this, in my opinion, is a great way to track sort of consumer spending or discretionary spending. That has performed very well over time. If we look at a 5-year chart, let's go to a 5-year chart, a little bit bigger for us. Yeah, something else in here. Let's take that out. Yeah, so this is since 2015. You can see how the IYC has done. We can add in like S&P 500, and it's done a little bit better than the S&P 500. They're both very close, though. You see 36% increase for IYC, 32% for S&P. But generally speaking, you're going to have really good performance when you bet on the United States consumer. Trying to go back to some of the areas where, let's see here. Oh, it just totally disappeared on me. I think I zoomed out too far. There we go. So this is compared to S&P since 2002. And the purple line is IYC, the blue line is S&P. It's always easier to look backwards, but you get an idea here on how consumer spending performs over the long run, right? So you're always going to have, let's see this, trying to highlight here. This is 2018. This is right around the last crash. And you see that dip there when we had the China tariff stock market dip. And then let's go back to 2008, which is super hard to see on this stupid chart. You can see a small decline there during the foreclosure crisis. But long story short, regardless whether you like the IYC or not, I can tell you that United States consumer spending, if you follow that and you track stocks that are closely related to United States consumer spending, you're going to have your down periods like we're experiencing right now, but you are going to do very well over the long term. So it's not necessarily that IYC is the greatest ETF of all time. It's the one that I choose. But on the same token, I think the more important thing is that you try to identify consumer spending habits and get on those, right? So Apple, I guess, would be like another one. I like the ETF approach here, and we started to look at some of the holdings. I can return back. So instead of like just, Apple's not even in this one because they're a manufacturer, and most of these folks, as you can see, are actual companies or resellers. But when you think about trying to target consumer spending, if that's your goal, like it is mine, more often than not, then it's a lot better to spread out the wealth against some of the high targeted areas for consumer spending. So you see, we all know about Amazon, Home Depot, and McDonald's, and I guess I'd throw in Disney and Netflix too. If you just take these 5 and you think about the different facets of consumer spending that you're hitting with these allocations here, or these assets, which are part of a much bigger pie in the IYC. I hope that makes sense, but that's why I love to target these. This particular ETF, Lowe's, Starbucks, like basically, if you're in America and you spend $1 today, more than likely, you came across some of these brands, or you probably spent $1 on one of these brands, certainly over the course of a week. If you think about Starbucks and coffee, Walmart, there's other ones in here like Target and TJ Maxx and things that I like. So that's a little breakdown, but in terms of today, what I wanted to show you or call out is that we're finally having a downturn. This is 1 month. Let's go year to date. So year to date on IYC, 238.69 when things were going well, and then we all know what happened. It got down as low as 159. And then I think early April, we hit another decline of 167. Just last week, this thing was in the 207 range, 206 range, and for myself, I was saying, that's ridiculous given what's going on. So I have been watching this ETF like a hawk. I'm looking for more opportunities under 190, and let's see. They've been around, right? They've been really close. April 21st, we had a 190, had 192. Yesterday was a good day, if I can get it there, 194. But even at 197, as somebody who watches this ETF every day, it doesn't really excite me. I think my cost basis right now across several different buying periods is in at 190 even. So for me in particular, I'm trying to get under that mark. And I'm sort of hoping that the stock market continues to go down to a more, should we say, I guess, like intrinsic value. So hi there, we have a couple of additions. Guys, I'm just trying out this new live stream software here called, whatever it's called, StreamYard, and kind of testing out, learning the program. So I'm very sorry. There'll probably be some boring parts in here where I try to get organized, but just hang with me. There's a question on the expense ratio, 0.42 expense ratio, which is a great question right here. Is that a little high? And the answer to that question, I think, is it's kind of relative in the sense that you have to think about the performance of the fund as well as the expense ratio. I would say anything under 0.5, in my personal opinion, is a reasonable fee. If you do look at Vanguard, I don't know what Vanguard's, well, let's just take this I want to get out of iShares for a second, because they're all going to have similar. Vanguard, consumers, discretionary, VCR. All right, so Vanguard's expense ratio is 0.10%. So that is definitely lower than IYC. One of the things about expense ratios, though, that I think gets overlooked, particularly for small-time investors, and I consider myself small-time, if you got under $1 million in the stock market, you're definitely small-time, and that is certainly me. You're looking at 0.10%. You're basically spending $10, I think, on a $10,000 investment. Let's see, 10,000 times. Sometimes I get my zeros messed up. And that didn't, I don't think that's right, but take a look at ETF expense ratio. What you're going to see, here it is. Hopefully everybody can see this. Average ETF carries expense ratio of 0.44. So you pay $4.40 in annual fees for every $1,000. So yes, on Vanguard, you would pay approximately $1.10 compared to $4.40. That to me is, at the level that I trade in, it's almost immeasurable, right? It's almost like a cost of just doing business, which one you choose or which one you like. But it's a fair call out that IYC, I did not choose that one because I was searching for the lowest price ETF. I chose that one strategically based on some of the holdings that it had, and so on and so forth. JP, I saw your video about ETFs you like, but which ones out of these are redundant? Let's see, IYC, FDN, QQQ, ARKW. I would say FDN and QQQ are pretty close to each other. I'm actually pausing on FDN where my holdings are right now and trying to get more QQQ. I need that price to go under $200 just for me. That's what I'm personally looking for. Let's go look at those for a second. Oh, by the way, let me see if I can find this. MarketWatch just did a little thing on, sorry guys, I'm not good at doing two things at once. MarketWatch just did a little thing on FDN. Hopefully I can share it. There's a story. It's kind of like grain of salt sort of stuff, but it was a nice little thing. Let's see. If I can copy and paste this link, I will share it. There we go. This is free. This doesn't cost you anything to look at this article, but it sort of talks about the FDN and obviously, you know, its performance over time, blah, blah, blah. And it compares it very specifically to QQQ. I think the QQQ is winning this year. The thing that I like about the QQQ and the reason that even though I hold FDN, FDN is just internet-based stocks, and we can look at those on Yahoo. I use Yahoo a lot because I already know where everything is on it. It's not an endorsement that it's the greatest, you know, it's not the greatest website of all time, but it's helpful. Oh, geez, that's not right. There we go. So let's look at holdings. So here's your FDN holdings, right? Amazon, Facebook, Netflix, PayPal, Cisco, Salesforce, Alphabet, Snap. So again, there's a little summary over here. Normally invest, largest and most actively traded in the internet industry. So very specifically the internet industry, which makes sense if you look at these names. These are mostly .com kind of names. Now, if we go to QQQ, they expand quite a bit. So they get into like medicine or medical companies and consumer companies. Let's take a look at their holdings. Microsoft, Apple. So Apple and Microsoft are not in the FDN. Amazon is, Facebook is, Alphabet is, Netflix is. Then you get Cisco is, but there's PepsiCo and Intel. And if you're a Tesla fan, I'm pretty sure that Tesla just entered the QQQ. So that in this time when we're likely going to see some more market volatility, AKA deals coming around, then I'm kind of thinking for myself that I would rather buy QQQ on the market dip right now because it's just spread out a little bit better. And it just feels, I'm not worried about any company in FDN going bankrupt, first of all. That's the least of my concerns. But QQQ having the Tesla exposure, and the medical exposure. Let me see if I can get to their website. You should definitely check out every ETF's website that you're interested in. Because you can, I mean, they're all pitching you, right? They all want you to buy. But somewhere down here, sector allocations. Okay, so here, this is QQQ, by the way. Information technology, Microsoft, Adobe, this is the percentage shares that they have in there. You also get NVIDIA, which I'm a big fan of. NVIDIA is tough because it's tough to buy as a standalone stock for a guy like me because I don't keep up with it almost trades, based on computer sales and stuff. And I believe in NVIDIA's future, but it's kind of a roller coaster. As soon as some stupid report comes out that says people aren't buying cell phones, NVIDIA tanks. And everything like it tanks, Intel, etc. But if you can sneak it in an ETF like you can here, I kind of like that. And that's one reason I do like QQQ. Communication services, which sounds kind of lame. This used to be telecom, but they switched it to communication services and threw like Google, Facebook and stuff in there. You also get, I just did a video game stock report or stock video, whatever. And you get some video games in here, which is cool. And that's definitely something that in this time frame, we're looking at video game stocks and they are very promising for the rest of the year, I think, as well as into the future. Consumer discretionary, there's Tesla, Starbucks, Booking Holdings, some good stuff. Healthcare, for the record, by the way, I'm not like a huge healthcare stock trader. I know I've done some of those vaccine things lately, and that's just because I get really worried about young investors jumping into penny stocks in healthcare because they're just so unpredictable, and I hate to see people lose money when there's much safer plays. These would be probably the lion's share of the much safer plays out there. They're not going to bump as high, but you can sleep at night if you have your savings account in place like that. And then on consumer staples, you got Pepsi, Costco, Walgreens, Kraft, and kind of crap there. And industrials, this is another area I don't play industrials at all, zero. But it's nice that QQQ has them. And because this is a market cap weighted ETF to some degree, like a CSX, which I believe is a railroad company, a CSX tanks let's say over the next 2 years, eventually they'll drop out of QQQ on a very slow wind down, and the loss from CSX that you may have had will basically be minimal. You know, so it's a nice little exposure without getting into all the risks of holding individual stocks. All right. Okay. The next thing that I was going to talk about that I thought was kind of interesting was this, since we alluded to medical stocks. Reuters has this really cool graphic. It's sort of buried on their site. I don't know why they don't put it on here, but it kind of tracks all of the vaccine things going on. Now, unfortunately, I didn't bookmark this, so you just have to give me a second. It's under like graphics, so let me see if I can find that. 1 second. Graphics, here we go. I'll put this link in. If you're only stopped by here for a second, totally save this link to browse later, because this is very interesting. I'm going to skip through the introduction and just get right down to it. There are more than 70 vaccine candidates development around the world. They have them broken into these different things, including drug therapies. And you can kind of get a read on all the stuff that's out there, the companies that are making it, and then links on Reuters to read some more, right? So the reason that I thought this was helpful, and I think it's really good for anybody who is considering trying to get into this game of vaccines, is one, that please understand that there's a lot of players. So I kind of picked on Anonio on one of my recent videos, and nothing against them. It's just like, man, this is a competitive field. And while Anonio's done a really good job of their press, of telling the whole world that they have, you know, a potential solve in the works, it doesn't really help when the rest of the world's working on the same thing. Because we're here's an Inovio. And that's a Novio. I'm looking for Anonio, I believe. Anyhow, the bottom line is, guys, there's not it seems like there'd be a shit ton of money for these vaccines. Like if one guy gets it, you know, he's going to make $1 billion. They might make $1 billion, but if it goes to like Gilead and Remdesivir, like $1 billion isn't even anything, right? 2 billion, 3 billion, $5 billion on Gilead's balance sheet. I hate to say it's inconsequential because it's still a lot of money, but this is a gigantic company. So don't expect Gilead to shoot to the moon just if Remdesivir suddenly is prescribed by every doctor in America. It'll be big, but it's not going to be a game changer for that individual stock from a fundamentals perspective. Now, the thing that does come into play is that sort of exuberation. So Remdesivir hits the market, every doctor prescribes it. You kind of get that PR boost and that, you know, everybody running for Gilead and the price goes up. But over time, from a fundamental play, if they brought $5 billion in, it would barely touch their bottom line. And you can rest assured that any one of these companies and drugs that goes makes it to the market in America, the government will be watching, and the government will make sure that the price inflation is dealt with, because we can't have a $10,000 drug as the only cure, right? So the government will come in, they'll either subsidize or they will simply prevent the drug company from having a market manipulation position on making too much money off these vaccines. So just, I'm not the expert on this topic, but I did want to say that because I know that these drugs are getting a lot of attention and the companies behind them are getting a lot of attention. So just a quick bit on that. All right, let's see. The other big news that I wanted to talk about was the Grubhub acquisition or proposed acquisition. So let me get through here. Let's find a website that I actually would click on myself. I don't have Wall Street Journal. Now this is Jim Cramer, so but I just wanted to get to the comments here. And what I really like about this, so first of all, you're not going to make much money on Grubhub if you didn't get in about 5 minutes before this thing went out. But what I really love is the flip side of it, which is the, is the partner, right? So getting in with Uber, I like Uber as a potential wild card play during this pandemic time where it's not that expensive of a stock. Look, it's not the most fundamentally greatest stock you're ever going to see in your life. But if you want to look at something that you can get in for a very small price, and I brought up the stock here. Let's take a look at year to date. So it was sort of high flying at 41. If you got in on the lows, you could have got it for 15. And then it was sort of humming around 25 or 28, and then it bumped on Grubhub. Their stock's going to be the big winner here. However, for the long term, a 5-year play on Uber, particularly if the market runs down more sizably over the next few weeks, if you could get Uber, let's say for another under 25, right? And you have the money and you've built all your fundamental positions and you can get it under 25, man, I'm not going to buy a ton of it, but I will probably get 50 shares and just throw it off into, for 5 years and see what happens. I mean, there's a lot of promise here, and the concept, yes, ride sharing is going to get hit hard. However, it's also about to bounce back once the world gets back to normal, or at least somewhat normal. And then what we've seen with this pandemic and the lockdown is just the carryout orders are unbelievable. And some of these restaurants are surviving slowly by that. So if Uber buys Grubhub, I think that puts their meal delivery market share in and around 50%. You look for a buy point, hopefully below 25 if you get lucky. That's a place where I'm going to be trying to just buy in and let it ride. You don't look at the fundamentals, whatever you do, because they're not great. I'll try to bring them up here. So obviously you have no PE, there's no profitability. They were talking about profitability before the end of 2020. I'm sure those plans got pushed back a little bit. So don't get it for that. There's no dividend. It's pure speculation that this company continues to grow. And I think that it's a safe bet's a weird word, but I think it's a safe prospective play, so to speak. So that's all I'm going to say on that one. Okay, well, that was my sort of first test of all this stuff. I'm going to hang out for a couple minutes if you have a question. But otherwise, I wanted to bring the software out. And if you guys can tell me, if this was a good format, did the sound work? Obviously, I'm stumbling a little bit over my words and trying to get some good information out to you, but each one of these will get better. But yeah. Feel free to post any last second questions. We'll look for them. Let's see while I'm waiting for that. Let's see how we're doing. And the S&P is up. See right here. Whoops. See the S&P is now up 0.10%. Dow is up 0.48. And surprisingly, the NASDAQ is the one down at 0.28. So unfortunately, I don't really like these green days right now because I'm trying to buy and I refuse to buy at current prices because it just doesn't feel right. But hopefully we'll get a downturn soon. So, all right. Well, I didn't see any questions come through. I will do more of this, but I'm going to end this one for now and try to get a feel for how it looks and how it feels on the big screen. So thanks everybody who joined, and I will try to crank out more of these. Have a great day.